Chapter 2, Financial Markets and Institutions. Following are the learning outcomes from this chapter. After going through this presentation, students would be able to understand the financial markets and institutions, and then understand and analyze the basic structure of primary and secondary markets, debt and equity markets, organized and over-the-counter markets, capital and money markets. They'll be able to explain the functions of financial markets and institutions. So financial market is a place where exchange of funds takes place against some kind of a future cash flow. It could be a business activity from certain operations, or it could be just increase in asset prices. So that is the purpose of making this exchange of funds. A financing decision is purely exchange of funds against this kind of a paper. So the source of funds is called capital, and the way these funds are placed is called the capital structure of funds. So a firm can either raise money through issuing a bond, which is called a debt market instrument, or borrowing, or it could offer ownership of its own company, and that is called equity, equal participation. So the extent to which a person or more persons want to participate in a company as an owner is determined by the amount of money they're willing to invest. So that's the meaning of capital structure. Capital structure essentially defines how the company would like investors to invest in that organization. A financial asset, therefore, is created when these investors are willing to spare money as capital in return to future cash flows. And that can happen either as debt or equity. Now, there is something also called as a hybrid, which is a mixture of debt and equity, which we'll come to later on. So the flow of capital takes place as follows. Investors move their money to corporation, and in return, the corporation agrees to share a part of their future cash flows or future profits with the investors. So here's how the flow looks like, in particularly the public corporations. Now, we've studied that corporations are organized in different ways depending on the nature of ownership. Now, here we're just talking about public corporations. In fact, the rest of this book or chapters are organized that way. So a corporation receives money from investors through financial markets or through financial institutions. A financial institution is a organization like a corporation essentially, but the nature of that organization called financial institution is very specialized. A financial institution raises money from investors who are called depositors or premium policy holders, etc., who are obliged to give money to the institution in return to some other obligation, such as if it's a bank, then the financial institution is promising safety of deposits. If it's an insurance company, then the financial institution is promising an indemnity against a future loss. So that's the role of a financial institution. Investors can flock to either the financial markets to directly give the money to the corporation, or they can go to a financial institution which does a vetting of its own in order to determine the eligibility of the corporation. Now, what do you mean by vetting or eligibility? The meaning of that word essentially is the worthiness of the corporation to receive money against a financial asset. So in simple words, it could be a rating or evaluation of bond instruments, which we will talk about in bond markets chapter, how credit worthy the corporation is in order to receive capital from either the financial market or financial institutions. And generally speaking, financial institutions are better at doing that as compared to the corporation directly approaching investors. So the corporations in return could either share their profits with their investors or reinvest that profit back in themselves. Once again, So the financial markets are defined as primary or secondary. Primary markets are those in which a financial instrument is offered to investors for the first time. A secondary market is one in which the financial asset is really traded between two investors. Now, there are some financial assets which cannot be traded between two investors, and these are like our certificate of deposits. A CD has the name of the investor imprinted on it. So if that is the case, it cannot be traded. There are some certificate of deposits that can be traded, which just have the name of the borrower or the financial institution that offered that certificate of deposit. Then moving on, so secondary markets generally are very good for stocks, bonds, and some commercial papers, some certificate of deposits, etc. These are called financial instruments. A stock is a part ownership of a company. So if a company issues 100 shares or stocks, then a person holding one stock is 1% owner of that company. A bond is not like that. A bond is just an obligation of the company to pay money to the investor in a fixed cash flow format. It does not offer any ownership to the investor. A commercial paper is similar to a bond, except that commercial papers are typically issued for durations that are less than 1 year in term. Bonds are more than 1 year typically. Okay, then the financial markets could be organized as equity and debt. Equity, as we just talked about, is essentially shares or stock, and they offer a part ownership of an organization. Bonds are just a loan, or debt is just a loan, a simple term loan from a bank or a bond issued directly by the company to investors. Next, financial markets could be also foreign exchange markets. So for example, dollar is traded against the yen, or euro is traded against the Chinese renminbi, etc. These are happening in foreign exchange markets, and these are extremely volatile. Then there are commodity markets in which currency can be exchanged for commodities such as gold and silver and copper and iron, etc. So these are called commodity markets. Then finally, we have derivative markets. Derivative markets typically consist of futures and options. A futures market is a market in which we agree to a deal today, but really we don't exchange anything until a future date. So no financial asset is handed over until a certain specific date in future. So options are essentially a contract in which certain amount of money is traded only if there is a trigger that's happening. So for example, there could be a call option or a put option, and that happens at the privilege of the investor who purchases that option. So more of that in a more advanced finance book or a class. Derivative markets, it's sufficient to know, are highly complicated, and one must understand the financial instrument carefully before participating in it. A financial intermediary, just described before, is an organization that essentially raises money from investors, and it provides liquidity in the financial market. So these are large organizations that accept money from small investors in bulk, and these funds can then be invested in financial assets. Some examples of financial intermediaries we talked about were banks, insurance companies, but there are more. There are mutual funds, hedge funds, and pension funds that invest large sums of money on behalf of individual investors who are not really large in nature. So they are called retail investors. There are two types of investors. Corporations can also be investors. Typically, corporations invest large sums of money, and there are retail investors. Typically, retail investors do not invest that kind of a huge amount of money. So financial institutions could be commercial bank. Commercial bank's primary nature is to accept deposits and make loans. They provide liquidity and stability to financial markets because anyone who needs money can get it for a given purpose. An investment bank participates in creation of financial assets primarily. That's called underwriting. So the process of underwriting is essentially issuing a new bond. And the key word here is issue. In a primary market, the word issue means creation of a new security. So investment banks typically explore the market and say, hey, what is the price that a new share or a new bond could be traded at? And that share price could be set up at the time of the issue of that stock, which is called initial public offering or IPO. Insurance companies such as auto insurance, life insurance could purchase or offer policies to customers and in return indemnify these purchasers or investors for certain loss, such as loss of life or loss of an auto or an accident, etc. So insurance companies usually, if their policy expires without any harm, which is hopefully usually the case, they have these large sums of money which are not refundable to investors. So during the time in which the insurance companies don't have to pay anything, they take that money and invest it in financial markets. Now, how do financial intermediaries function? So this chart actually shows how a financial intermediary functions. Corporations take money from a financial intermediary. In return, so right here, corporations take money from financial intermediary. In return, corporations promise future cash flows to financial intermediaries who do the same thing with depositors. They take money from depositors and promise future cash flows, such as in the case of a bank deposit, they can return their money with some interest, or they can return a certificate of deposit with a greater amount of interest, or just promise the deposit to be returned safely and securely. So let's look at some cash flow examples. So for example, in the case of a bank, a depositor deposits cash with a bank. The bank accepts deposits from large number of small retail depositors, and that actually adds up a lot and very quickly. So and not all depositors will withdraw their money at the same time, assuming that there is no bank run. A bank run is a situation in which lots of depositors flock to a certain bank and try to withdraw their money immediately. And this is called a bank run because banks typically do not keep that kind of money in their branches or inside their Federal Reserve accounts. So it's because this money is invested in creation of loans. And so when banks give loans, they are essentially earning interest on those loans to be paid to their depositors. So the money is working for both banks and depositors. However, if all the depositors come simultaneously to withdraw their money, the bank really does not have it because it's already invested in loans. Loans are typically long-term in nature. Deposits are on demand. So that is called asset liability management or liquidity management for a bank. Now, what does a bank do with that money? They give loan as a cash to a company or a corporation. And that's how the cash flows from depositors to companies. Now, the same thing can happen in case of an insurance company, which is another financial intermediary. So the policyholder purchases policy through cash. The insurance company accepts the cash and issues the policy. And in return, the insurance company can buy a bond of similar duration as the maturity of that policy in cash from a corporation. So in other words, the insurance company is also putting its capital to use. Insurance companies have typically got millions of policyholders at the same time, and not all of them will be invoking or making a claim against the insurance company. And that is a model which these financial intermediaries, banks and insurance companies, as an example, are running on. Now, the function of financial markets and intermediaries is essentially very important for an economy. The health of an economy can be measured through the health of its financial markets and intermediaries. So that's why it's critical that the financial markets and intermediaries are performing up to their best potential. They transport cash across time. They transfer risk from individual to the corporation. So individuals are not willing to take a risk on corporations, nor do corporations most times want to invest that time and money to raise their bonds from small investors. So there's a risk transfer. There's a benefit of diversification because typically banks and insurance companies and other financial intermediaries know the corporations very well, and so they run their due diligence on these corporations through proper departments such as corporate credit departments, and therefore this offers the benefits of diversification to the individual investors. Financial markets and intermediaries provide, like we said, liquidity. Anyone can raise cash for a new business venture, given their credit rating, obviously, through the financial markets and intermediaries. So this is called liquidity. If somebody has a new idea for a business or would like to expand an existing business, they can get the funds from financial markets and intermediaries. And so they also provide payment mechanisms. Banks typically help customers transfer money from either themselves to another customer or from themselves to corporations or vice versa. So this is called payment mechanism, also part of liquidity provided by financial intermediaries. And they provide very useful information because some bonds, stocks, commercial papers, certificate deposits, etc. are publicly traded. They're obliged to provide information on the prices, on the yields or interest rates, etc. to all the public. So even if for a person who's not invested in a financial market, they can get to know what the going rates are and helps them easily participate in the market thanks to that. And that is chapter 2. Thank you for listening.